So here's the problem. You want to own rental properties, but you live in a market where owning real estate really doesn't make sense from a cash flow standpoint. So you started looking in other markets and you quickly realize there's thousands and thousands of locations where you could invest. Now you can easily get stuck at this stage and never get started buying rental properties. So in this video, I want to help you out by making it simple, giving you a recipe so you can quickly find a market that makes sense, that has cash flow, that also can grow over the long run and build you the most wealth as a rental property investor. And we're getting started right now. Welcome to the podcast, Real Estate Investing with Coach Carson. I'm your host, Chad Carson. You can also call me Coach Carson, and this is a show to help you get out of the financial grind so you can spend your time doing what matters. Now, I want to jump right into this by saying that picking the right place to invest is a really important decision. I kind of compare this to gardening in your backyard. Now, if you want to be a good gardener, I know there's a lot of ingredients, a lot of things you have to get right. Like you want to pick the right seed, you want to have the right growing season conditions, but more than anything, having the right soil to grow it in is the starting point. You could have the best seed, the best plant, you could be the best gardener in the world, but if you don't have the right soil to plant it in, everything else is just going to be a lot of work and you're not going to get as many results. Well, with rental property investing, it's the same way. The soil that you're investing in is the target market. It's the place where you're choosing to invest. It's going to be an uphill battle in some markets. It's going to be a very easy process in others. But the reason so many people get stuck at this decision of where to invest, and I know this because I coach a lot of people both through this podcast and also in my private community, Rental Property Mastery, is that you're not sure what makes a good market. There's so many criteria that you could evaluate. So I'm going to give you two, kind of this simple recipe idea of what makes a good market. Two criteria. And number one is that you need strong demand. And number two, you need affordability. And let me explain what each of those mean. So for number one, strong demand, what I mean is you want a really strong demand from your end customer, the person who's going to live in the house, your tenant. And the reason this is important, think about how you actually make money with a rental property. You go out and buy the property, and most of us get a mortgage to buy the property. So hopefully you get a fixed interest mortgage. So you fix the biggest cost you're going to have on this property, your mortgage payment, over a long period of time, like 30 years. But then if you have strong demand, if you have a lot of people who want your property, then what will tend to happen over time is the price you can charge for rent will go up and up and up. And sure, there's going to be some flat periods, maybe even a little bit of a downward trajectory, but over the long run, in a really high demand area, the rents tend to go up. And so you make money because your biggest cost is fixed over the long run, and the rent that you can charge goes up. And so the spread, the difference between those two is how you make money and cash flow and growth over the long run. So how do you know if a location has strong demand from your tenants? It's really simple. The population tends to be growing. If you're in a location, and I'm thinking of examples of like Austin, Texas over the last 5 to 6 years. If you look at the population trend of Metro Austin, Texas, it's gotten bigger and bigger by a large percentage. And then the other thing that's happened is that the people who are moving there have good, high-paying jobs. So if you combine those two things, the population's increasing and people have good jobs that pay well, all other things being equal, that translates into high demand for you as a rental property investor renting to your tenants. So in a moment, I'm going to give you a shortcut to how to figure out which locations might have the strong demand that we're talking about. But first, let me talk about the other criteria that I mentioned, affordability. Now, you probably already know this, but having strong demand by itself isn't enough. You might even live in a place where you've had really strong demand and now the prices are really high and the rents are really low. And as a rental property investor, it's difficult to buy a property, to rent it, to pay all of our expenses, to pay our mortgage payment and still have a positive cash flow. So what we're looking for is another metric called affordability. Now you can measure affordability in a lot of different ways, but as a real estate investor, my favorite metric is something called a rent to price ratio. This is just a simple formula where you take the median rent for a particular location and you divide that by the median price of a property in that same location. Now let me give you a few examples of how I calculate that just so you could do it on your own if you're looking at other locations. Now let's go back to Austin, Texas, which I talked about earlier as a really strong demand metro market where the population is increasing. And I just did a simple Google search to look for median rent in Austin, Texas. And I clicked on Zillow. There's lots of places you can look at, but Zillow has an easy user interface and really good statistics. And I searched for the median rent for houses in Austin, Texas in the metro area. And I found that at the end of 2023, the rent was $2,700 per month. Kind of an interesting side note, the rents had actually gone down in Austin during 2023, which was probably the result of a lot of new supply of apartments coming onto the market. But the median value for single-family houses in that same market was $531,000. So when you divide 2,700 by 531,000, you get a 0.5% rent-to-price ratio, which is actually pretty low on the affordability range. This would be one of your less affordable markets. But let's look at a couple more examples. I did a search for median rent for my home state, Columbia, South Carolina, which is the capital of South Carolina. And the median rent there was $1,461 for a single family house. And the median value for a house was just at $225,000. So the rent to price ratio is 1,461 divided by 225,000, or 0.65%. So a little more affordable than Austin, Texas. Now I'll give you a third example in the much more affordable range. And I did a search for Flint, Michigan. And the median rent there was $750 per month. And the median value was $52,000. So the rent to price ratio is 1.44% in Flint. Now, 1% is kind of an interesting number because if you're a real estate investor, you might have heard of a rule of thumb called the 1% rule, where a lot of investors, if they want to get cash flow, try to find properties where the rent for the property, the monthly rent, is equal to about 1% or better of the purchase price of the property. So in Flint, Michigan, even the median, the normal rent to price ratio is better than 1%. That means that if you really hunt for properties, you'll definitely be able to find some that make a positive cash flow. So for me, as a long-term buy and hold real estate investor, there's really a sweet spot for a market where you have both. Where number one, you have strong demand from your tenants. So you have a population growth happening in that area, and you have job income that is high enough that your tenants can afford to pay your rent. And then number two, you also have good affordability. So you have a rent to price ratio that makes it possible for you as an investor to buy a property and still to make positive cash flow so you can afford to hold this property over the long run. Now, it's actually pretty simple to evaluate both of those. If you want to evaluate the growth of a location, you can get free data at census.gov. I'll put a link to that in the podcast and YouTube description. And you can use this website to evaluate all sorts of cities all over the country and figure out what they have grown in the past. You can even Google and find a lot of decent projections on what that city will do in the future. You can also find some pretty good aggregated data like Googling top 10 lists, top 10 fastest growing metropolitan areas in the country. And I'll show you an example of that in here just a minute. But the point is, this is a big, broad metric to find the areas of the country that are growing the most. And then you can use the tool I just showed you of figuring out the median rent of a location and the median property values to estimate the rent to price ratio. So you can do this evaluation on hundreds or thousands of cities all over the country to figure out which ones have the best balance. But as you can imagine, that would get pretty tedious pretty fast. So I want to share a shortcut with you, something I've learned for myself and I've helped other students to use to really get to the core of the issue and find the markets that really have the best balance of both. So the shortcut for me has been to compare the best places to invest to a solar system. So imagine our own solar system. We have the sun at the very center. The sun is the center of gravity. It's the center of energy. Everything kind of revolves around the sun in our solar system. And in a good economic market, it's the same way. You've got these big cities where all the jobs happen, where all the dynamism is. This is the transportation hub. Think about New York City, think about Chicago, Los Angeles, San Francisco. Those are the biggest cities. But you also have medium-sized cities. You have the Nashville, Tennessee, Dallas, Fort Worth, Denver, Colorado, Atlanta, Georgia, Charlotte, North Carolina. These are suns with their own solar systems, and around these suns, you have these little planets, these little satellites that are floating around. And what's cool when you think about it this way is all the jobs and all the growth and the things we talked about in number one, having a strong demand for your tenants, often revolve around that dynamic economic center that happens in those big cities. But then what also happens, because there's so much growth, because there's so much demand, you very rarely find affordability right there in the center of the sun. And so what I like to do is to go a little further out. Start there, start with a big economic center that you like, and then start hunting around for a suburb, for a satellite city that is also a good place to live and hopefully has its own identity, its own culture. I actually read a book called Big Shifts Ahead a few years ago by John Burns, who's a real estate consultant. I'll put a link to that book in the video and show description. And he described these locations as Surban locations. They're suburban locations that have urban qualities. So these are my favorite places to invest because a lot of the people who want to buy a house, but they like living in an urban location, they like the walkability, they like the restaurants and the food and the culture that happens in an urban area, but they want to start a family or they want to have their own house. They just want to buy something. So they go out to the suburbs, but they want kind of a mix of both. So John Burns described those locations that have walkable town centers, have character, have historic places in these suburb areas as Surban centers. So if you can find these suburban places that have a little bit more affordability than the center of the sun, but people can still live there and can still have the benefit of the jobs and economic dynamism that happens by being in that solar system, you can find these little pockets that balance those two things we're looking for of affordability and demand. So let me give you an example to show you what I mean. And I'm going to give you an example of an area I'm familiar with. I grew up outside of Atlanta, Georgia, and Atlanta is a big metro area. I believe it has 6 or 8 million people in the entire metro area. And depending on how you define Atlanta, which is the center of the metro area, it's going to be around $400,000, maybe $380 to $405 is the median price for a single family house in Atlanta. And then if you look up on Zillow, just like we did before, and look for the median rent for Atlanta, you'll see that it's around $2,500, so $2,470. So if you calculate the rent to price ratio overall for Atlanta, it's about 0.57%. So that's not much different than what we saw in Austin, Texas, another dynamic, big economic center. But as I said, Atlanta is a big place. This is a big sun, and there's a bunch of little satellites outside of there. So I'll give you a couple of examples. One place I'm familiar with, I went to high school in College Park, Georgia. It's right where the Atlanta airport is located. It's got a little small historic district. It's convenient to everything in town. The subway has a line that goes there right in the center of town. And it has a lot of historic houses. College Park has a median rent of just under $1,900 per month, $1,893. And again, checking on Zillow, the median price for houses in College Park is about $288,000. So the rent to price ratio of $1,893 divided by $288,000 is 0.65%. So more affordable than the economic center of Atlanta. And what's interesting, even within the satellite city of College Park, if you go to different parts of College Park, it's got its own little system. If you want to keep this metaphor going, you have the Earth and then you have some moons. You have little more affordable parts of College Park compared to the most expensive parts of College Park. And then if you take it one step further, a lot of what I talk about on this channel is how do you find good deals? If you pay a retail price, just what the market price is, that'll be one type of investment. But if you really hunt and you look for opportunities and you could buy it for 10%, 20%, maybe even 30% below the full value of the property, you've now combined that, finding a good deal in a suburban satellite location around a good economic center. Now you've got that growth with good affordability and hopefully some cash flow as well. So you can use this concept of satellite cities around the sun of an economic center anywhere you look. Every city's a little bit different. Every system's a little bit different. But if you can use these two principles, finding strong demand areas where growing population and growing jobs is happening, and then hunting around and searching for the locations that have more affordability, that's how you find the winners. That'll be good long-term investments for you as a rental investor. So now that you know the ingredients or the principles for what makes a market a good place to invest in as a real estate investor, I want to give you a takeaway. I want to simplify all this, give you a checklist, or maybe you can think about it as some homework so that you can apply this to your own hunt for a target market. And I'm going to do this in 5 steps. Step number 1 is just to do a quick Google search and look for the top highest growing metro areas in the US. So I did a quick Google search, and I don't have any affiliation with this particular website, but they did a good job of aggregating all the data from the census and a couple other locations. And you can see here's a list of the top 20 fastest growing US metro areas. It has places like Austin, Texas, Raleigh, North Carolina, Orlando, Florida, Charleston, South Carolina, and my home state, Houston, Texas, Sarasota, Florida, San Antonio, Texas, Dallas, Fort Worth. You see a lot of these locations are in the South and in the West. That's where a lot of the growth is happening. And that doesn't necessarily mean that other parts of the country, if you're in the Northeast or the Midwest, are bad places to invest. They might not have quite as much growth. But the point is, and that's step number 2, pick a city either on a list like this or one that you already have a natural affinity for, and just make sure there's at least some good stuff happening. There's some growth happening. There's some population movement. There's some jobs happening. And so just pick one to start off. Step number 1, use a list to kind of be a shortcut. Step number 2, pick your sun. Pick the center of your economic universe that you're going to be investing in. And the step number 3 is to spend a little bit of time looking for that satellite city, that Surban location that's around the bigger sun that you're starting with. And you can just use my real simple tool of affordability. Look at the rent to price ratio. Start looking at the median price rents. Start looking at the median sales prices of properties. And this is really quick data that you can get on Zillow. You can get on Redfin. You can get a lot of these free data sites now. And you can do this kind of thing in 15 or 20 minutes. So once you get a few candidate satellite cities, step number 4 is to do a little bit deeper dive into that particular location. And what I like to do is look at individual properties. So if you were to go on Zillow, for example, you went in College Park and the place that I was looking at earlier, College Park, Georgia, I would want to look at sold properties in the last 6 months. And I would typically sort those properties to find the lowest sales at my location. So if you look at the lowest 10 to 20 sales and you do another rent to price analysis and say, all right, here's what that property would rent for. Here's what that property is worth. And try to figure out what's the rent to price ratio of some of the best deals in the market. And a good sign if you do that exercise is that you would be a little bit jealous. You'd have a little bit of FOMO and say, man, somebody got a really good deal on that property. It's much better than the 1% rule, or it's around the 1% rule. That would be a good sign that maybe if you hunted and you looked hard, you could find a deal that's similar to that in that same market. So after you've validated that particular location, that there is some opportunity there, step number 5, and this is a really important one because every city that you're going to invest in and every market that you're going to invest in is more than just the data. It's just more than just the numbers. Is you got to start identifying some people to help you out in finding your good deals and managing your properties. So it'd be great if you already have a network, if you could look for local real estate meetups, if you could look on the Bigger Pockets forums to see if there's any forums or discussion groups for that particular location. Start searching for property managers, for real estate agents, reach out to some of them, start talking to them about buying rental properties. Or maybe another shortcut is you can Google and look for turnkey rental companies. These are companies that buy up rentals and they fix them up and then sell them to passive real estate investors. And if you can find a couple turnkey companies that are operating in the place you're in, that could also be a good sign that there's opportunities there. So all of those steps, 1 through 5, are just ways of filtering down and figuring out pretty quickly which target markets have more opportunity than others so that you can have strong growth, number 1, and you can have affordability to put together the best ingredients for a good deal for you. I'm very confident that if you apply these principles and you go through those 5 steps, you will find a target market that you can invest in. But when you solve one problem, you always create another problem. And one problem you might find is that you want to know how to run the numbers and analyze deals once you start looking at particular properties. So in my next video that I want to recommend to you is how to run the numbers on a duplex rental property. And this is one where it's a case study. And I actually looked at a property in my local market in the upstate of South Carolina, and I showed you exactly what I think about on a granular street level, running the numbers with a spreadsheet on how I can figure out if this is a good deal or not. Is it one I want to buy, or is it one I want to pass on? If you want to watch that video, it'll help you get more confident so you can take the next step to actually make offers and buy properties. So if you like this episode, I would always love to hear from you. If you're watching on YouTube, just to leave a comment below. I read every single comment. And if you're listening on the podcast, send an email to podcast@coachcarson.com. I would love to hear from you as well. This is the podcast Real Estate Investing with Coach Carson. I'm your host, Chad Carson. You can also call me Coach Carson. This is a show to help you get out of the financial grind so you can have more time to do what matters. See you next time.